The 5 main pension news. Subscribe to stay informed. Winter fuel payment. How to get more money. If you just missed the state pension age cutoff. The Department for Work and Pensions, DWP, recently disclosed that a substantial number of older individuals, approximately 158,803, missed out on winter fuel payments. The reason for this was that they did not claim their state pension until after the qualifying week, which ended on September 25, 2023. Consequently, these individuals were not eligible for the additional pensioner cost of living payment. This figure is expected to rise as Pensions Minister Paul Maynard MP shared details on the number of individuals who claimed their state pension between the end of the qualifying week and December 17, 2023. However, the precise number of people who did not receive winter fuel payments after missing the deadline remains unknown. To understand the potential significance and costs of expanding eligibility for winter fuel payments in the winter of 2023-24, Labour MP Rebecca Long Bailey asked the DWP to conduct an assessment. In response, Pensions Minister Paul Maynard MP explained that individuals are entitled to winter fuel payments if they reach state pension age by the end of the qualifying week, which has been established in law since 1999 as the week commencing on the third Monday in September. This time frame allows sufficient time to verify eligibility, perform necessary calculations, and issue payments before the Christmas season. In 2023, a total of 158,803 people claimed their state pension between the end of the qualifying week, September 25, and December, data available until December 17. These figures were provided by the Pensions Minister in his written response. The DWP also announced that by Christmas, they had successfully distributed approximately 11.9 million winter fuel payments and pensioner cost of living payments, totaling over £4.8 billion, benefiting around 99% of eligible pensioner households. This tax-free financial aid, ranging up to £600, aims to assist with energy bills and household expenses during the winter months. The DWP ensured that recipients who have not yet received their payments need not be concerned, as the distribution process will continue into the following month. Individuals who do not receive their payment by January 26, 2024, are advised to contact the Winter Fuel Payment Center, highlighting a potential need to file a claim. To identify the payment in their bank accounts, pensioners should look for a payment reference beginning with their national insurance number, followed by DWP-WFP. The DWP emphasizes the importance of double-checking bank statements for this reference number before making any inquiries. Regarding eligibility for winter fuel payment, the majority of pensioners will receive the payment automatically. However, certain individuals may need to apply if any of the following criteria are met. 1. They do not receive benefits or the state pension. 2. They only receive adult disability payment, housing benefit, council tax reduction, child benefit, or universal credit. 3. They reside in Switzerland or an eligible EEA country. For those who have previously received a winter fuel payment, an application is only necessary if, since their last payment, they have either deferred their state pension or moved to Switzerland or an eligible EEA country. To make a claim, individuals can submit the Winter Fuel Payment Claim Form by post or contact the Winter Fuel Payment Center via phone. The necessary form and address details can be found on the Gov UK website. The alternative option is to call the Winter Fuel Payment Center at 0800 731 0160 during the specified working hours, Monday to Friday, 8 a.m. to 6 p.m. It is important to have the national insurance number, bank or building society details, and the relevant marital or civil partnership date, if applicable, on hand when making the call. The DWP also encourages low-income pensioners who are not already receiving pension credit to check their eligibility, as they could potentially increase their yearly income by an average of £3,900. To quickly ascertain eligibility and estimate potential benefits, older individuals, their friends, or family members can utilize the pension credit calculator featured on the Gov UK website. Alternatively, they may directly contact the Pension Credit Helpline at 0800 991234, which operates from 8 a.m. to 6 p.m. Monday to Friday. In summary, Pension credit provides additional financial support for individuals over state pension age living on a low income. The benefit guarantees a minimum weekly income of £201.05 for single pensioners and £306.85 for couples, with higher amounts for those with disabilities or caring responsibilities. Starting from April 2024, the weekly payments will increase to £218.15 for single pensioners and $332.95 for couples. New claims for pension credit made before March 5, 2024, which are subsequently successful, will also qualify for the final cost of living payment of £299. To be eligible for pension credit, individuals over 65 who reached state pension age before April 6, 2016, must have a weekly income less than £240, 90 for singles, or £351, 45 for couples. Furthermore, qualifying for pension credit also grants access to other forms of assistance, such as housing benefit for renters, support for mortgage interest for property owners, council tax discount, free television license for individuals aged 75 or over, aid with NHS dental treatment, glasses, and transportation costs for hospital appointments, assistance with heating costs through the Warm Home Discount Scheme, and discounts on Royal Mail redirection services during house moves. Additionally, mixed-aged older couples are affected by changes in the law. The 2019 legislative amendment classifies couples where one partner has attained state pension age while the other has not as working age couples for the purpose of means-tested benefits assessment. Consequently, mixed-age couples are ineligible to claim pension credit or pension age housing benefit until both partners reach state pension age, whereas they previously qualified for the more generous benefits as soon as one partner reached state pension age. To utilize the online pension credit calculator, individuals must provide details of their earnings, benefits, pensions, savings, and investments. This includes information about their date of birth, residential status, location, blindness registration, existing benefits, and their respective weekly amounts, carer's allowance payments received, pension amounts from various sources, employment earnings, and financial assets. After inputting this information, the calculator provides an estimate of potential weekly benefits. Users can review and modify their responses before finalizing the calculation. The tool also offers the option to print the answers, which facilitates the completion of the application form without the need to retrieve the same details again. However, certain individuals cannot use the pension credit calculator, such as those deferring their state pension, owning multiple properties, self-employed individuals, or individuals with housing costs other than mortgage payments or rent covered by housing benefit. To initiate a claim, individuals can begin their application up to 4 months before reaching state pension age. Although claims can be made any time after reaching state pension age, retroactive claims are limited to 3 months. Applicants must provide their national insurance number, income information, savings and investment details, and bank account information when applying by phone or post. For backdated claims, applicants should have income, savings, and investment figures from the desired start date of their claim. Online applications can be submitted if the individual has already claimed their state pension, and if no children or young individuals are included in the claim. Now we move on to the next important news. How some UK households can boost their income by £1,390 after April. The Department for Work and Pensions, DWP, has recently made an announcement that will bring a cash boost to individuals receiving attendance allowance starting from April. This increase is in line with the September Consumer Price Index, CPI, inflation figure of 6.7%. Moreover, the state pension will rise by an impressive 8.5%. With this adjustment, certain state pensioners will enjoy an extra £1,390 every month. For those individuals who receive the full new state pension alongside the attendance allowance, they will be entitled to £1,309 every 4 weeks. For those who receive the basic state pension and also qualify for attendance allowance, they will receive £169.50 per week starting from April. When combined with the higher rate of attendance allowance, this equates to a total of £1,112 every 4 weeks. To be eligible for attendance allowance, individuals must be at or above the state pension age and have required assistance with personal care due to a physical or mental disability for at least 6 months. The disability should be severe enough to necessitate help with activities like bathing, dressing, eating, using the toilet, or effectively communicating one's needs. In certain cases, supervision may be required to prevent putting oneself or others in significant danger, such as needing someone to monitor a medical condition or dietary needs, or even simply requiring company during dialysis. It is worth noting that attendance allowance can be obtained even if no one is actively providing the required care, and even for individuals who live alone. The government offers 2 rates of attendance allowance, depending on the extent to which the disability affects an individual. The lower rate, which amounts to £68, is applicable if assistance or supervision is required throughout the day, night, and dialysis. The higher rate, valued at £101, is for those who consistently require help or supervision both during the day and at night. This increase in payments seeks to provide better financial support to individuals who rely on attendance allowance to cope with their disabilities. It acknowledges the importance of ensuring that those in need receive adequate assistance while also accounting for the rising costs of living. As April approaches, these adjustments will likely alleviate some financial burdens and enhance the well-being of attendance allowance recipients. Now, let's move on to the third important news of today's edition. Don't forget to subscribe to the channel to stay updated on the news. How to retire 3 years early with this simple national insurance hack. A golden opportunity has emerged to significantly enhance your retirement funds. Acting promptly could potentially increase your savings by a substantial amount, nearing £200,000 in the best-case scenario, and the best part is that it won't cause any pain or stress. With this financial boost, you could relish a more prosperous and fulfilling old age, or even decide to bid farewell to work years earlier compared to if you passed on this opportunity. So, what has brought about this chance for a financial windfall? The recent reduction in national insurance rates. The government has lowered the main rate of national insurance contributions for employees from 12% to 10%. This means that approximately 27 million individuals should see an increase in their take-home pay in their next paycheck. Anyone between the ages of 16 and state pension age, earning more than £242 per week from one job, will benefit from this change. According to the Treasury, this tax cut translates to an annual benefit of about £450 for an employee with an average salary of £35,400. However, the actual amount saved depends on one's earnings, potentially reaching up to £754 for higher earners. Undoubtedly, a boost in take-home pay is always welcome, and for many people, might be necessary to keep up with rising expenses. But for those who have some extra capacity to save, this presents the perfect opportunity to divert that additional money into their pensions before they become accustomed to having it. By doing so, they can avoid the typical challenge of cutting back on present-day spending to secure a more secure financial future during retirement. In essence, individuals can continue enjoying the same lifestyle they have had thus far, all the while significantly improving their financial outlook for the years to come. Bertrand Pohl, a pensions expert at wealth management firm Evelyn Partners, enthusiastically advises, "I've been telling all my friends to do this." While some people might need the extra money for essential expenses, for many, it will simply be spent on trivial things. The occasional round of drinks at the pub, and then it's gone. But if you put that money into your pension, you'll truly notice a difference later on. Curious about the potential benefits of this strategy, Money Mail enlisted the assistance of Evelyn Partners to calculate the value it could bring. Basic rate taxpayers could witness their income increase by up to £62.83 per month as a result of the tax cut. However, if this additional income were directly deposited into their pension, it would immediately become worth £78.53 per month, thanks to the 20% tax relief provided by the government. The ultimate value of this monthly increase by retirement age depends on how many years one has left in the workforce. The younger the individual, the greater the benefit. For instance, a 25-year-old could potentially accumulate an additional £134,389 in their pension thanks to this savings strategy. Remarkably, even a 65-year-old with just 2 years left until retirement could enjoy a boost of £2,064. The calculations by Evelyn Partners assume that, after accounting for fees, the savings will grow at a rate of 5% per year thanks to investment growth. A higher rate taxpayer at the age of 25, for example, could be up to £179,687 better off when they retire. Their monthly savings of £62.83 would receive a top-up of £105 through 40% tax relief. A 45-year-old could potentially increase their pension by over £50,000, and a 35-year-old by almost £100,000, assuming the funds are left invested until the age of 67. These calculations err on the conservative side as they don't account for any wage growth. If an individual moves up a tax band over the course of their working life, the benefits could be even greater. Additional rate taxpayers receive 45% tax relief, resulting in even larger savings. Plus, if an employer matches additional contributions, the pension boost could be worth twice as much without any extra cost. Workers participating in a pension scheme through a salary sacrifice arrangement could benefit even further by diverting this additional income into their pension, as highlighted by Becky O'Connor from pension firm PensionBee. Salary sacrifice occurs when an employee agrees to give up a portion of their salary to contribute directly into their pension. Most employers who offer this scheme match the increased contributions made by the employee, who also receives tax relief on their pension payments. Consequently, both the employer and employee save on taxes since no national insurance is paid on pension contributions. O'Connor explains, if you have a salary sacrifice pension at work, then there is a further tax benefit of putting more into your pension. You can reduce your income tax and your national insurance bill. This is especially handy if you are just above the threshold for paying higher rate tax, as by paying more into your pension, you may go back into the basic rate tax bracket. Alice Guy, from investment platform Interactive Investor, estimates that salary sacrifice could save £150 per year for an earner making £30,000 and £250 per year for someone on £50,000. These savings would further bolster retirement funds if diverted into a pension. Dean Butler, from pension firm Standard Life, emphasizes that millions of workers are currently not saving enough to meet their retirement income expectations. He advises, if you find you have extra money each month, whether because of a salary increase or a tax cut like this month's national insurance reduction, it can be a good idea to put it in your pension before you become accustomed to it. Even a relatively small increase now could make a real difference in retirement. To increase pension contributions, individuals should contact their workplace pension provider and inform them of the desired increase. While the national insurance cut offers a fantastic opportunity for numerous workers to enhance their pensions simultaneously, individuals can also seize opportunities throughout their working lives. For instance, receiving a pay raise can serve as an opportune moment to bolster one's pension before adjusting to the increased income. Likewise, the month when one pays off their student loan and the corresponding payments cease presents a prime opportunity for additional contributions. Stephen Cameron, from pension firm Aegon, points out that more chances for tax cuts may arise later in the year. He states, there are high hopes that the March budget might include cuts in income tax. This could boost take-home pay further, and similar to the national insurance cut, integrating the habit of saving this surplus before getting accustomed to the extra income could significantly benefit your future living standards during retirement. Cameron adds that the national insurance cut may prompt individuals to consider increasing their own pension contributions, as national insurance contributions fund the state pension. He explains, national insurance contributions from today's workers pay for today's state pensions. With less collected in national insurance after the cut, the future funding of the state pension with the current triple lock will be more challenging. So it makes double sense to use your national insurance savings to boost private pensions rather than relying too much on the state pension. There are two important news left in this edition. Stay with us. State pension tax, the campaign to end it before the next uprating. Over 17,000 individuals have come together to sign an online petition advocating for the elimination of income tax on the state pension, with the goal of reducing the tax burden on pensioners. This petition, aptly titled "Make State Pensions Tax-Free," has now reached the threshold of 10,000 signatures required to elicit a response from the UK government. During the 2024-25 financial year, the personal tax allowance threshold will remain frozen at £12,570. This freeze implies that elderly individuals with an income exceeding £242 per week may find themselves liable to pay income tax. Taking into account the annual uprating on April 8th, those receiving the full new state pension will witness an increase in their payments from £203.85 per week to £221.20. Considering that payments are typically made every 4 weeks, this amounts to £884.80 per pay period. Over the course of the 2024-25 financial year, this increase totals £902, thus elevating the annual income from the state pension alone from £10,600 to £11,502. Consequently, only £1,068 remains before surpassing the personal tax threshold. Therefore, anyone receiving additional income of £89 or more per week in addition to the state pension may find themselves facing a tax bill. Similarly, those on the full rate of the old or basic state pension will observe an increase in payments from £156.20 per week to £169.50. This sums up to £678 per pay period, with an increase of £692 over the 2024-25 financial year, raising the annual income from £8,122 to £8,814. In this case, only £3,756 remains before exceeding the personal tax threshold, equivalent to additional income totaling £313 per month. The essence of the Make State Pensions Tax-Free petition, hosted on the Petitions Parliament website, is that the government should remove income tax on state pension payments to reduce the tax burden on pensioners. As the personal tax allowance has been frozen, some pensioners will now need to fill in a tax return. We believe income from state pensions should be tax-free in the same way as benefits are. Once the petition reaches 100,000 signatures, it will be considered by the Petitions Committee for further debate in Parliament. Shortly after the autumn statement announcement, LCP, Lane Clark and Peacock, a consulting firm, warned that an increasing number of pensioners could be drawn into the tax net based solely on their state pension. This concern arises from the fact that state pensions are paid in full before tax deductions, leaving no automatic means of collecting the owed tax. In such cases, HM Revenue and Customs, HMRC, may employ a system known as simple assessment. Under this system, the Department for Work and Pensions, DWP, would notify HMRC at the end of each tax year regarding the total amount of state pension received by individuals. If this pushes someone over the income tax threshold, they will receive a tax bill. LCP explained that HMRC might send a letter to pensioners after the end of the tax year, informing them of unpaid tax on their state pension and requesting payment before January 31st of the following year. The experts further cautioned that retirees might have received and spent their entire pension during one financial year, only to receive a tax bill in the subsequent year. For pensioners who possess both a state pension and a private pension, any tax due will be collected through the code applied to the private pension. Since 2021-22, the income tax threshold has remained frozen at $12,507. Based on online statistics from DWP obtained in November 2020, more than 2.3 million pensioners received a state pension of £195 per week or more, and factoring in subsequent state pension increases, these individuals might find themselves with a pension exceeding the tax threshold during the 2024-25 financial year. While some of these pensioners may have private pensions to cover any tax owed, others primarily rely on their state pension as they did not make alternative private pension provisions. LCP estimates that over 400,000 individuals, approximately 1 in 5 of those affected, have no other source of income from which HMRC can collect the tax owed. This group now faces the risk of unexpected tax bills and should consider setting aside a portion of their state pension each month to ensure funds are available to meet future tax demands. Sir Steve Webb, a former pensions minister who now serves as a partner at LCP, expressed concern over the situation, stating, "Millions of pensioners have been drawn into the tax net for the first time in recent years, primarily due to the multi-year freeze on tax thresholds. Many now face unexpected letters from HMRC requesting payment for tax they may not have realized was due." Any pensioner with a pension during the next financial year above £242 per week will have tax to pay, and if they lack a private pension through which the tax can be collected, they may need to set aside money for an unwelcome tax demand. LCP believes that many individuals who could be caught off guard by unexpected bills likely receive the old state pension and reach their state pension age by 2016. State pension payment rates from April 2024. The calculations below depict the current annual rates for the full new and full basic state pensions. Typically, the state pension is paid every 4 weeks, resulting in 13 payments made throughout the year. The actual amount received depends on the number of years of national insurance contributions one has made, with approximately 35 years required for the full new state pension, though this number may be higher for those who were contracted out. Further details can be found on the Gov UK website. Current annual full new state pension, £10,600 weekly, £203.85. Every 4-week pay period, £850. 48. 5% uprating from April 2024 to £11,502, an increase of £902. Weekly, £221. 20. Every 4-week pay period, £884. 80. Current annual full basic state pension, £8,000 weekly, £156. 20. Every 4-week pay period, £624.80. 8. 5% uprating from April 2024, £804, an increase of £692. Weekly, £169. 50. Every 4-week pay period, £678. For additional information regarding the additional state pension, increments, and invalidity allowance, please refer to the Gov UK website. We move on to the last news of this edition. The shocking truth about pensioner poverty in the UK. Cut to NI is a consequential decision amidst a growing number of pensioners struggling to make ends meet. Recent government data exposes a worrisome trend, with a 20% increase in individuals over 65 re-entering the workforce. Many pensioners express concerns about their declining quality of life, as 18% admit they don't have sufficient funds in their pension accounts. Even those who have paid off their mortgages still feel financially restricted, with their pension payments falling short of providing a fulfilling life. Unsurprisingly, worrying about retirement funding has become a significant mental health strain for 15% of pensioners. In light of Chancellor Jeremy Hunt's recent announcement to cut national insurance (NI) contributions by 2p, effective from January 6th, there are apprehensions regarding the potential impact on state pension funding and the triple lock mechanism. While this reduction presents an annual saving of approximately £447.86 for individuals with an average salary of £34,963, alternative sources of funding may be needed in the future, potentially through general taxation. These concerns amplify the urgency for UK pensioners to explore other options beyond government actions, one of which is equity release. A groundbreaking report by Senior Capital, a leading later-life lending specialist, reveals alarming statistics amidst the cost of living crisis. Nearly 1 in 5 pensioners, 18% in the UK, find themselves living on the poverty line, lacking sufficient funds in their pension accounts. The gravity of this crisis becomes evident when considering that there are nearly 16 million individuals over the age of 60 in the UK, constituting a fifth of the population. Furthermore, the number of individuals over 85 is projected to double to a staggering 2.6 million in the next 20 years, according to the Health Foundation. Rudy Kaitan, managing partner of Senior Capital, emphasizes how equity release loans can address this predicament by allowing pensioners to remain in their homes while accessing their capital to support their retirement. thereby alleviating mental health strain. The soaring house prices over the past half-century have resulted in thousands of pensioners possessing significant capital wealth that remains inaccessible for their present retirement needs. In the early 1970s, the average house price stood at a modest £4,975. However, according to the latest figures from the Office for National Statistics, the average house price has skyrocketed to £290,000. Equity release offers a solution for those struggling, as it enables them to unlock the considerable value tied up in their homes, providing much-needed funds to alleviate financial burdens amid the ongoing cost of living challenges, all while retaining their residency. The aforementioned report highlights the pressing need for such capital access methods. 1 in 7 pensioners now identifies worrying about retirement funding as their most significant mental health strain. Further research demonstrates the concerns faced by Britain's retirees amidst the cost of living crisis, with 22% reducing or entirely stopping spending on medications and 15% experiencing meal skipping due to financial constraints. According to Senior Capital's data, 21% of respondents have paid off their mortgages entirely but lack sufficient funds in their retirement accounts to lead fulfilling lives. In addition, recent UK government data reveals a remarkable surge of 20% in full-time and part-time self-employed individuals aged 65 and above, increasing from almost 435,000 to over 523,000 within just 3 months. The number of over 65s working as employees or self-employed has also reached a record high of 1.468 million as of June 2022. Among the self-employed workers aged 65 and above, approximately 35% account for the total, with self-employed over 65s representing roughly 12% of the 4.24 million self-employed workers in the UK. The rising cost of living has compelled these individuals to seek additional income for their retirement. As more pensioners find themselves teetering on the poverty line, equity release loans have experienced a staggering 23% year-on-year increase, serving as a vital lifeline amid the cost of living crisis. The Equity Release Council reports that over 93,000 Britons opted for this type of loan in 2022 to create financial liquidity, stability, and improve their quality of life. To cater to the growing number of homeowners eager to access the £800 billion tied up in property wealth, Senior Capital emerged as a specialist provider of later life lending solutions. Rudy Kuyten, managing partner of Senior Capital, emphasizes the significance of loan-to-value (LTV) ratios when contemplating equity release and the need for flexible products in the underserved later life lending market. Kuyten highlights that exploring a range of options beyond traditional remortgaging is crucial for retirees and those planning for retirement. Equity release mortgages, particularly those offering flexibility through limited prepayment penalties, can prove more advantageous than traditional mortgages. They allow homeowners to unlock the equity accumulated in their properties, providing tax-free lump sums to supplement their regular income, all while retaining ownership and the right to reside in their homes until their own choosing. This solution proves especially beneficial for retirees or those with limited income, offering financial stability and flexibility without the burden of higher mortgage repayments. Thank you for watching. Don't forget to subscribe to the channel to stay updated on the important news.